Alright guys, welcome to my YouTube channel. In today's video, we'll be discussing about how to calculate gold pips and also how to use the proper lot size for your trade positions, meaning how to calculate the right lot size for whatever account size that you'll be using. The right lot size is not a fixed number. It depends on several factors. Calculating pips for gold is a bit different from a normal standard currency pair, and here is a breakdown of how it works. So the first topic we'll be talking about is how to calculate pips for gold, and the second one will be how to calculate and use the proper lot size for gold, right? So this is one question that a lot of students have been asking me, and this topic has been one of the topics that have been on my mind to talk on, because I've seen a lot of new traders, a lot of newbies blow their accounts just because they did not understand how to calculate gold pips or the proper lot size to use while trading gold. And this is a pair that almost every forex trader love to trade, and you need to understand that gold pips, the way you calculate gold pips or the way gold moves, is totally different from the way a normal currency pair actually moves. So guys, let's dive straight into the chart right now. Let me show you guys how to calculate gold pips and how to use the proper lot size for gold on your trade position. So let's go. All right guys, so here we are on the screen, where I'll be taking you guys step by step on how to calculate pips for gold and how to calculate a proper lot size for gold. Whatever account size you use, I'm going to show you guys different steps on how to calculate pips and different steps on how to calculate lot sizes. So this video is going to bring an end to the way you trade gold and how you blow your account on gold, because this video is made to enlighten you and to open your eyes to so many things that you've not known before. So let's continue guys. If you see what I have on my screen right now, you will see the pips and points calculation for gold, right? So for gold, a pip is typically the first decimal place in the price quote. A movement of 0.10 in the price is considered 1 pip. Example, if the price of gold moves from 1950.10 to 1950.20, that's a change of what? 1 pip. Do you guys understand? Now, point or pipette. A point or a pipette is a smaller unit of measurement representing a fractional pip. So this is the fraction of a pip, right? For gold, a point is the second decimal place. A movement of 0.01 is considered 1 point or 1 pipette. Example, if the price moves from 1950.10 to 1950.11, that's a change of 1 point or 1 pipette. There are 10 points in a single pip for gold. You need to remember this, and this is the exact reason why gold movement is totally different from currency pair movement. Do you understand guys? So let's take a dive into, let me analyze the chart right now and analyze the chart, and then we see the potentials of this. So here we are on gold. So looking at the opportunity on gold, I'm doing like a real analysis, right? I'm doing like a real analysis. So over here it's an order block that has already been mitigated, right? This is an order block that has already been mitigated, so we're going to make this in some kind of supply zone. And you see that after that mitigation, we had a shift to the downside, which we can clearly say we have a change of character on gold. And if you look to the downside, you will see that all of this is an open imbalance, right? So this is an open imbalance that has not been filled on gold, so we call that imbalance. And if you look down here, you will see where gold actually reacted from before impulsing to the upside. So gold actually reacted from this breaker block right here. So this is the breaker block that gold has just reacted from. That's why we are seeing a push to the upside. So where is gold actually pushing to? So this is like a supply to demand flip. That's what we call breaker blocks, right, in SMC, because this is a supply that led to this break of structure and it had liquidity. If you mark it out, you'll see that we had a break of structure here, and then we had liquidity above this high, which would have made this supply a valid supply that price could have come there for people to want to sell, because the structure was actually to the downside. And unfortunately, price then trade above that supply zone only to go and mitigate the supply at this high. So now price has actually gotten to this level and then shift to the downside. Now we look out for this area right here. You see that this area over this level here, price just tapped into it, and now that price has tapped into it, what has price done? Price is now dropping to the downside. So let's take a look at what the market is doing at this particular level. Now for me, I believe that the price will be coming into this other block, right, where that impulsive movement started from. So this is more like a demand zone right there. That's more like a demand zone right there. So the price right now, it's on its way to this demand, right, on the cost to fill up this imbalance over here. So if you look at it, you see that price has actually created a liquidity right here that will be taken out. So let's go back to the topic of the day. Sorry guys, whenever I look at the chart, I'm always seeing trade opportunity. So let's go back to our chart. So let's say, for example, I want to sell gold from here, right? I want to sell gold from this zone that has this liquidity at this particular high. This is some buy side liquidity. The next thing after this analysis, spotting the buy side and the sell side, and we've seen our entry, which is we are going to be selling from this level right here. Now let's use the short position tool for an example. So right here we pick our short position tool here as our entry, and then we move our stop loss. So let's say this is our stop loss right here. This is our stop loss right here, and then we are targeting this zone right here as our take profits. So what am I expecting? I'm simply saying price is going to come all the way into this other block, which is my supply, and sell off into this demand zone right here. So now we are going to be calculating the pips. So now the first thing first is this. Now if you want to calculate the pips, you see this is my entry. This is my entry right here in white. This is my stop loss in gold, and then this is my take profit down here also in gold. So now let's use the calculator first before you will use the short position tool. So what you want to do here is our entry is 3373.60. so you come to your calculator, you say 3370. Let's look at it so we don't make mistake. 73.60, 73.60. Then you click the minus, right? Minus the stop loss price. So the stop loss price is 3383.66. So you do 3383 point what? We look at it again so we don't make mistake. Be very careful. 0.66. Then you equal to. you see the price it gives us here, right? So this simply means it's from the entry price, which is 3373.60 to 3383.66, is a total of what? 100 pips. It means you're risking 100 pips. Now you see this particular last number here is a decimal number. You're not going to calculate this number. This is a decimal number. Okay, now if you look at the position 2, which is your short position, right, up above here in the stop loss level where you can see stop, you will see that we have the exact number we have on our calculator. This exact number we have on our calculator is what we have here. And I told you guys that when calculating pips on gold, we don't include the last number, which is the decimal number. So what we have here is 10.06. remove the 6, you will only have 10.0, which is 100 pips. It means your stop loss from your entry to your stop loss is a total of 100 pips. So now let's do the calculation from our entry all the way to our take profit and know how many pips we are targeting for take profit. Since we are risking 100 pips for our stop loss, let's know how much we are also targeting to make on our take profit if it hits take profit. So now we are going to cancel this one and come to our entry, right? So what we are going to do right now is entry. So we are going to say 3373.60, 3373.60 minus take profit 3303.17, which is 3303.17. Always make sure you don't make mistakes with the number, so you have to always cross check what you're doing if it is right, because if you make mistakes with the number, it's going to affect the lot size. We are going to calculate lot size as well. So now let's do you see what we have here. We have 70.4, meaning your take profit is 704 pips, right? A total of 704 pips. So you're going to take out this 3. This 3 is just a decimal number. It's just a decimal number, so we are not going to include it. You are targeting 704 pips. Now if you look at this, your 2 right here, which is your short position 2, you will see that right here it gives you a target. It means you're targeting 70.43. Now take out the 3, is just 70.4, meaning this is 704 pips. That's what you're targeting for take profit. Look at your risk reward ratio. Your risk reward ratio tells you that your reward is what? 7. This is 1 to 7, meaning you're going to make 7 times what you're risking. You're risking 100 pips to make 704 pips, right? So it means that this is the way to calculate gold pip using your long or short position 2, and also to know your risk reward ratio. And this is also another way to calculate gold pip using this calculator right here. This calculator right here is going to help you calculate your gold pip properly. Now if you don't want to do this, maybe you didn't do any analysis at all, but you just want to know how many pips the market has moved, right? You can also use this tool right here. This is a tool I use, right? You just want to know how many pips the market has moved from this low all the way to this high. That's what you want to do. What you can use is this tool right here. You see this tool, you just pick it. It's called price range, I think. So let me just go down to the toolbox so you guys can actually see what the name is. So come to my favorite This is a price range. It is called price range. So in this price range, you just want to use the price range from this level all the way to this high. This is you trying to know how the market has moved from this low to this high. So this is telling you that the market has moved 400 pips, right? So from this particular low to this particular high is 40.06, meaning you're taking out this 6 and it's just 400 pips. Now let's say on the downside, you want to calculate how many pips the market has moved from this high all the way to this low. You will see that the market has moved a total of minus 778 pip. Forget about the slash number. This is decimal number and we don't add it when we calculate gold pip. So this is a simple way for you to do what? This is a simple way for you to calculate gold pip. Okay, whenever you want to calculate gold pip, you can either use your calculator. Now what you do is your entry price minus your stop loss, or your entry price minus your take profit, and then you're going to get the actual pip that you're risking or the actual pip that you're targeting. So guys, what we'll be talking about right now is the lot size. So let's go over to the lot size. That's what we'll be talking about right now. Gold lot size, right? So guys, up next is gold lot size. This is what we will be talking about right now, how to calculate the proper lot size for gold. So this one is not too much, right? This is what I want you guys to pay attention to. So these are the important factors that you need to put in place before you calculate gold lot size. Number one, calculate your risk amount, right? So let's say you have a certain amount in your account and you are willing to risk a certain amount out of the main account. So you don't want to blow your account. Now you know how to calculate your pips. So what you do right now is calculate the risk amount. So first, you need to determine the specific dollar amount you're willing to risk on every single trade. This means you are willing to lose a certain amount. For example, you're trading a $20,000 account and you're only willing to risk $1,000 per trade, right? This means that for you to blow that account, you have to lose 20 trades. You understand what I mean now? So you already know how much you're risking, and so calculate your risk amount. Then number two, determine your stop loss. You don't know the exact lot size you'll be using on gold, except you know the stop loss in pips, right? Determine your stop loss. Before you can calculate the lot size, you must have a trading plan and know where your stop loss will be on that particular trade. Like I did my analysis. You guys saw when I was doing my analysis, you knew I had my stop loss in place and my take profit in place. So you have to determine where your stop loss will be. Right now, this is a quick one, guys. Make sure you sign up with my recommended broker. Access Market is the best broker right now in the industry. Make sure you use the link below, the link in my description, to sign up for Access Market. Now, if you sign up with Access Market using my link in the description, you will be getting 50% on your first deposit. Meaning, if you deposit $500, they will be giving you 50% of that $500 for you to trade and withdraw, right? If you deposit $1,000, they will also be giving you 50% of your $1,000 for you to trade and withdraw, right? Now, why Assets Market? The reason for Assets Market is because they have the tightest spread, they have the fast deposit, they have the fast withdrawal, and they have all types of deposit and withdrawal method. These people literally credit you in seconds. It does not take them time for them to credit you. You understand? They have the tightest spread in the industry. So make sure you use the link in description to sign up with Assets Market and trade with them. You will experience the best spread so far, most especially on gold. If you are a gold trader, then you should be trading with Asset Market because they are the best when it comes to spread, right? So let's get back to our chart. I said number 2 factor, determine your stop loss. So before you can calculate the lot size, you must have a trading plan and know where your stop loss will be. The stop loss is the number of points or pips between your entry price and the price where you will exit the trade to limit your losses. For gold, a pip is often considered a 0.10 price movement, while a point is a 0.01 movement, right? 3. This is where you come to calculate the lot size. The lot size is not static. It changes with every trade based on your stop loss distance. A wider stop loss will require a smaller lot size, and a tighter stop loss will allow for a larger lot size while maintaining the same dollar risk. Macro lots, which is 0.01, are your friend for a smaller account size, and a 1% risk, you will always be using macro lots. A 0.01 lot size on gold represents 1 ounce of gold, right? So if you're trading a small account, always make sure you go with the macro lots. Don't risk too much, and always be risking 1% of your account size. I know a lot of you want to make good money, you want to risk, you want to over risk, but always make sure you use the proper lot size so you don't blow your account, right? So now what we do is there is this called Nash market that I usually use, right? This is called Nash market. This is it over here. It's called Nash market. So you can actually go and download it from the App Store, right? This is very, very good. It's perfect when it comes to calculating gold. So I've been using Nash markets for over 3 years now, right? For over 3 years. I first downloaded Nash market in 2022. Before I started using Nash market, I've been using other apps, but they are not as accurate as Nash market. You guys know I trade gold a lot, right? So Nash market is the app I use in calculating my lot size on gold. So now what you want to do is put your account size. So let's say, for example, a $20,000 account size, and then we are risking 1%, and then the instrument we are trading is gold, right? Now remember, we were going short on that position, so you click on short. So let's go all the way back to that trade. Remember guys, we had that trade analysis, so we are going back to it right now. So this is it right here. We have to start all over again because I removed some stuff. So this is where we were willing to sell from, right? This is where we're willing to sell from. So we are still going short on this one. We'll do both the long and short example on this. So my entry is here. My stop loss is just up here. And then my target for take profit is just at this. No. Yeah, my entry is here. My stop loss is there. And then I'm targeting this level right here. So now what I'm going to do is we are going short, remember. So my entry price 3383.55. So at this level, I'm going to do entry price. Put your entry price 3383. Make sure it's correct. Always cross check. 337, you see I almost made a mistake here. 337349. So put it 3373.49. And then here we are going to put the stop loss. Remember, you can also choose to put the stop loss in pip or in price, but I love to put it in price. So I'm going to put 3383.55, 3383.55. I think it's 55. I always cross check to avoid mistakes. So if you already know the pips, this is the pips right here. You remember it was 100 pips, right? So it just showed us the pips that the pip here is what? 100 pip. So now we go for the take profit. We want to put the take profit price 3303.04, 3303.04, which is about same thing, bro. You see, it gives us 704 pip exactly. So what do we do now? We are just going to click calculate. So once you click calculate, here you have your lot size. Here you have your lot size on gold. So this is the lot size you will be using. You see what it gives us here? Instrument, gold. Asset class, metals. Direction, we are going short. You see the arrow is pointing short, right? Then position size, this is the lot size that you will be using. Meaning if you go onto your Meta 5, right? If you go onto your Meta 5 right now and you're going short, you'll be putting this is where you put the lot size. So lot size is 0.19, right? So we are going to put lot size 0.19, and then you place your trade, right? Remember, this is where you put your lot size. This is gold, 0.19, and that's it. You're going short. Now look at your stop loss. It tells you that this is the price for your stop loss. This is the percent you're risking. It gives you the amount you're risking. It says you're risking $200 and you're risking 1% of your account size. Now, this is for take profit. It simply says your amount to make in take profit is $1,400 and your percent is 7. This is 1 to 7. Risking $200 to make $1,400. Then it also analyzes it for you. Trade analysis, risk to reward 1 to 7, right? 7%. National value it gives you, leverage used it gives you, margin used it gives you. Then it gives you a comment, excellent risk reward on this position. If it is a poor risk reward, it will also tell you that it is a poor risk reward. So this is how you calculate your lot size when you're trading gold. Let's say, for example, we are going long, the opposite. So you pick your long position to this be my entry, my stop loss right down here, and then I'm targeting to take profit at this supply. Now we go back to Nash markets. Remember, we are risking same amount, right? Now when it comes to $20,000, let's say for example $20,000 was the account size that you started trading forex with. You might be trading using Nash market. Let's say the first day you risked 1%, you lost. Second day you risked 1%, you lost. Don't adjust your account's balance to the amount that is. Leave it at that $20,000. Even if on your Meta 5 you already lost some money and you're down like $19,000, don't change the price here on this Nash market to 19,000. Leave it at $20,000 and continue to risk 1%, because definitely you're going to win to cover up your losses, right? So this is what we do. We are going long on this particular trade. So I'm going to remove all of these prices, right? I'll remove all of these prices so we actually start afresh. So right now I'll click the long position, no longer the short position. Then I'll put my price. So right here, my entry price is 3303.19. That's my entry price, 3303.19. Then my stop loss is 3292.09. 3292.09. 3292.09. Oh, we are risking 110 pips on this one. Then for take profit, what are we targeting? We are targeting 3373.49. So we are targeting 3373.49, I guess. Let me go and check. Good, correct. So what next, guys? Just click calculate. This is my lot size, 0.18, right? So I go onto my my MetaTrader 5 and set 0.18. Then I place my trade, pam, right? I just place my trade, pam, and then it's gone. Then if you look at what I'm risking just $200 on this, and I'm targeting $1,266. The risk reward is 1 to 6, and it's an excellent risk reward, right? So this is actually how you calculate your pip on gold. This is how you calculate your lot size on gold. Hope this video actually helped you. If this video actually helped you, remember to click the subscription button, turn on the notification bell for more educational videos like this, and make sure to share these videos to your friends. Share it to the communities you are, wherever you're learning forex, your forex friends that are learning as well. Share this video to them. It might help them. It might save them from unnecessary losses, losing their money, blowing their prop account. This video can save someone's life. So make sure you send them this video and they will definitely thank you, right? And for the best broker, make sure to use the link in my bio to sign up with Asset Market. Remember, I have a free Telegram community, link in description. The community is totally free. I offer mentorship for free. I send signals for free. I do giveaways. I do prop firm giveaways. I do real money giveaways. So make sure you join the Telegram community for more value and for more educational content and to stay updated in the forex market. Thank you for watching. See you in my next video. Bye.